A sole proprietorship is the simplest and most common structure chosen to starting a business. A sole proprietorship is an unincorporated business owned and ran by one individual with no distinction between the business and you, the owner. You are entitled to all profits and are responsible for all of your business debts, losses, and liabilities. One important note of a sole proprietorship is that the business itself is not taxed separately. The sole proprietorship income is your income. Essentially, the business and the person are somewhat one and the same. A sole proprietorship is easy to form and gives you complete control of your business. You're automatically considered to be a sole proprietorship if you do business activities but don't register as any other kind of business. Sole proprietors are still able to get a trade name. However, it can be difficult to raise money because you can't sell stock, and there may be hesitation to lend to a sole proprietor. Since sole proprietorships do not produce a separate business entity, the largest risk is that business assets and liabilities are not separate from your personal assets and liabilities, which means you can be held personally liable for the debts and obligations of the business. Sole proprietorships can be a good choice for low-risk businesses and owners who want to test their business idea before forming a more formal business. Partnerships are the simplest structure for two or more people to own a business together. There are two common types of partnerships: limited partnerships, referred to as LP, and limited liability partnerships, referred to as LLP. Limited partnerships have only one general partner with unlimited flexibility, and all other partners have limited liability. The partners with limited liability also tend to have limited control over the company, which is documented in the partnership agreement. Profits are passed through to personal tax returns, and the general partner, the partner without limited liability, must also pay self-employment taxes. Limited liability partnerships are similar to limited partnerships, but give limited liability to every owner. An LLP protects each partner from debts against the partnership, meaning they won't be responsible for the actions of other partners. A corporation is a legal entity that's separate from its owners. Corporations can make a profit, be taxed, and can be held legally liable. Corporations offer the strongest protection to its owners from personal liability, but the cost to form a corporation is much higher than that of other structures. Corporations also require more extensive record keeping, operational processes, and reporting. In forming a corporation, prospective shareholders exchange money, property, or possibly both, in exchange for the corporation's capital stock. For federal income tax purposes, a C corporation is recognized as a separate tax-paying entity. A corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. A corporation can also take special deductions. The profit of a corporation is taxed to the corporation when earned, and then is taxed to the shareholders when distributed as dividends. This creates a double tax. The corporation does not get a tax deduction when it distributes dividends to shareholders, and shareholders cannot deduct any loss in the corporation. An S corporation, sometimes called an S corp, is a special type of corporation that's designed to avoid the double taxation drawback of a regular C corp. An S corp allows profits as well as some losses to be passed through directly to owners' personal income without ever being subject to corporate tax rates. Not all states tax an S corporation equally, but most recognize them the same way the federal government does and taxes the shareholders accordingly. Some states tax an S corp on profits above a specified limit, and other states don't recognize the S corp election at all, simply treating the business as a C corp. An S corp must file with the IRS to get S corp status, a different process from registering with their state. There are special limits on an S corp. For example, an S corp can't have more than 100 shareholders, and all shareholders must be U.S. citizens. You still have to follow strict filing and operation processes similar to a C corp. S corps also have an independent life, just like for a C corp. If a shareholder leaves the company or sells their shares, the S-Corp can continue doing business relatively undisturbed. S-Corps can be a good choice for a business that would otherwise be a C-Corp, but meet all the criteria to file as an S-Corp. Limited liability companies, also referred to as an LLC, allows you to take advantage of the benefits of both the corporation and the partnership business structures. An LLC protects you from personal liability in most instances, meaning that your personal assets, like your vehicle, house, and savings accounts, won't be at risk in case your LLC faces bankruptcy or lawsuits. Profits and losses can get passed through to your personal income without facing corporate taxes. However, members of an LLC are considered self-employed and must pay self-employment tax contributions towards Medicare and Social Security. An LLC can have a limited life in many states. When a member joins or leaves an LLC, some states may require the LLC to be dissolved and reformed with new membership, unless there's already an agreement in place with the LLC for buying, selling, and transferring ownership. LLCs can be a good choice for medium or higher risk businesses, owners with significant personal assets they want protected, and owners who want to pay a lower tax rate than they would with a corporation. The popularity of limited liability companies are mainly due to them being inexpensive, easy to form, and simple to maintain. Nonprofit corporations are organized to do charity, education, religious, literary, or scientific work. Because their work benefits the public, nonprofits can receive tax-exempt status, meaning they don't pay state or federal income taxes on any profits they make. Nonprofits must file with the IRS to get tax exemption, a different process from registering with their state. Nonprofit corporations need to follow organizational rules very similar to a regular C Corp. They also need to follow special rules about what they can do with any profits they earn. For example, they can't distribute profits to members or political campaigns. Nonprofits are often called a 501c3 corporation, which is a reference to the section of the Internal Revenue Code that is most commonly used to grant tax-exempt status. Franchising is also an option. In a franchise arrangement, the purchaser or franchisee pays a franchise fee, as well as ongoing royalties to a franchisor, and in return gains the use of a trademark, ongoing business support from the franchisor, and the right to use their system of doing business and sell its products or services. Most importantly, the franchisee is purchasing a proven system of operation and training in how to use it. New franchisees can avoid a lot of the mistakes startup entrepreneurs typically make because the franchisor has already perfected daily operations through trial and error. A great example of a franchisee is McDonald's. While each restaurant is owned by an independent owner, they pay fees to the McDonald's Corporation and operate with some oversight from the corporation. A joint venture is a legal organization that takes the form of a short-term partnership in which the persons jointly undertake a transaction for mutual profit. Generally, each person contributes assets and shares in the risks. Like a partnership, joint ventures can involve any type of business transaction, and the persons involved can be individuals, groups of individuals, companies, or corporations. Joint ventures are commonly used by companies to gain entrance into foreign markets. Foreign companies form joint ventures along with domestic companies already located in the new foreign markets the companies would like to enter. The foreign companies generally bring new technologies and business practices into the joint venture, while the domestic companies already have the relationships and requisite government documents within the country, along with being established in that domestic industry. A joint venture could work in a few ways, including a foreign investor buying an interest in a local company, a local firm buying an interest in an existing foreign firm, or possibly both. The foreign and local entrepreneurs jointly form a new enterprise. A subsidiary company is a business owned by a parent company. Subsidiary companies are separate legal entities created by the parent company or another party. An example of a subsidiary could be Google and Nest, who are both subsidiaries of the Alphabet Corporation, or Marvel Entertainment, which is a subsidiary of Walt Disney Entertainment. Oftentimes, a subsidiary may also be deemed as a foreign subsidiary corporation. which is a partially or wholly owned corporation that is part of a larger corporation with headquarters in a different country. A co-op or cooperative business is an organization that is managed by its members rather than operating as a private or public company. A cooperative is a business or organization owned by and operated for the benefit of those using its services. Profits and earnings generated by the cooperative are distributed among the members, also known as user owners. Typically, an elected board of directors and officers run the cooperative, while regular members have voting power to control the direction of the cooperative. Members can become part of the cooperative by purchasing shares, though the amount of shares they hold does not affect the weight of their vote.